You're standing at a counter. Could be a phone store, a rental car desk, a checkout screen. And someone asks the question you've heard 100 times. Do you want to protect that? And you say yes, of course you do. It's a few dollars, it feels responsible, and saying no feels like tempting fate. So you protect the phone, the laptop, the rental, the appliance. Little shields, one after another, on all the small stuff you could honestly replace with a single paycheck. And the whole time, the one loss that could actually end you, the one you could never write a check for, sits there completely uncovered. Nobody at any counter ever offered you that one. That's the quiet mistake almost everyone makes. We insure backwards. We armor the things we could afford to lose and walk around naked against the one thing we couldn't survive. Give me 12 minutes and you'll have one simple rule that sorts every policy you own and the name of the coverage that matters most, the one nobody's selling you at a counter. Let's do what we always do here. Put two people in front of the exact same decision, you and someone who prices risk for a living. You decide the way most of us do, by feeling. Will this thing probably break? Would it annoy me to pay for it? A cracked screen feels likely, and it stings, so yes, protect it. More coverage feels like more responsible. They don't ask whether it'll break. They ask one colder question. If this loss happened, could you survive it without any insurance at all? And how likely it is barely matters. What matters is how big the hole is. And that leads to the one rule this whole video is built on. Insure only what you can't afford to lose. Everything else you pay for yourself. That's it. That single line sorts every policy you'll ever be offered. Because insurance isn't for the annoying loss. It's for the loss that changes your life. Using it on small stuff isn't extra safety. It's just handing away money for a risk you were fine carrying yourself. Here's the belief nearly everyone carries in. Being insured means being responsible. So every shield you can add is a good one, and turning any of them down feels a little reckless. And it feels obviously true because of how our fear is wired. You can picture the small losses. You felt them. The dropped phone, the fender bender, the fridge that dies the week the warranty ends. So your brain guards hard against the losses it can see coming. But the truly ruinous ones, the ones that could actually take everything, are rare and hard to picture. So the same brain quietly files them under, "That won't happen to me." And that's the mistake. Not too little insurance and not too much. Insurance pointed at the wrong target. Loud coverage on the paper cut and nothing at all on the thing that could end you. So let's price the small stuff honestly, and you'll see the pattern fast. Start with the classic, the extended warranty. Americans pour about $50 billion a year into these, and only about 1 in 5 is ever even used. Here's the part that gives it away. The average warranty on a big appliance runs about $126. And the repair it's supposed to save you from? On average, it costs only about $26 more than the warranty itself. Think about what that means. You're paying almost the entire price of the repair, up front, every time, to avoid maybe paying for the repair. That's not protection. That's prepaying for a problem you'll probably never have. Same story with phone insurance. Call it $8 to $12 a month, plus a deductible of $50, $100, sometimes over $200 when you actually file. That's easily $300 a year to cover a screen repair that runs $100 to $400 once. And the rental car counter, where they ask if you want the collision coverage for about $30 a day. Here's the quiet part. Your credit card or your own auto policy very often already covers that. So you'd be buying, at a premium, something you already own. And underneath all three is one unavoidable fact. Insurance always costs more, on average, than the loss it covers. It has to. That's how the company keeps the lights on. Which means, on any loss small enough to absorb yourself, buying the coverage is a slow, guaranteed loss. You come out behind on purpose. Now watch the same rule work inside the policies you actually should keep. Take your car insurance. You choose a deductible, the part you pay before coverage kicks in. Most people pick a low one, $500, to feel protected. But raising that deductible from $500 to $1,000 saves you around 9% on your premium every single year. You're paying extra, forever, to protect a $500 loss, one you could cover out of a proper emergency fund without blinking. So the move is the same everywhere. Raise the deductible, drop the tiny add-ons, and self-insure the small stuff on purpose. Every one of those is a loss you can write a check for. And the rule already told you what to do with those, because there's really only one question you ever have to ask about any coverage. If the worst version of this loss happened tomorrow, could I write the check myself and be okay? If the answer is yes, you don't need the policy. You are the policy. Run 3 things through it. The appliance warranty. Could you cover a repair? Yes. The $500 deductible. Could you cover that gap? Yes. Your income. If you couldn't work for the next 3 years, could you write that check? Now stop. Because that one is not like the others. So far, this has sounded like a video about being cheap. Cut the warranty, raise the deductible, skip the counter add-on, but that was never the point. The point is what all that freed up money is for. Every dollar you stop wasting on a risk you could carry yourself is a dollar you can finally aim at the risk that could actually flatten you. Cutting the small stuff is how you fund the big stuff. And here is the danger your gut simply cannot feel. It has a loud, screaming alarm for the cracked phone, and no alarm at all for the loss that would take the roof over your head. So what is that loss, the one you can't write a check for? For most working people, it isn't the house burning down. It's simpler and closer than that. It's your paycheck stopping. Think about what your income actually holds up. The mortgage, the groceries, the savings, the retirement you're slowly building. Your ability to earn is the engine under every other number in your life. It is, quietly, the most valuable thing you own. And it's the thing almost nobody insures. And don't tell yourself it's rare. About 1 in 4 of today's 20-year-olds will be out of work for a year or more because of a disability before they retire. That's the Social Security Administration's own figure. 1 in 4. That's not a freak accident. That's a coin flip you take twice. And when it happens, it isn't a quick bounce back. The average long-term disability claim lasts nearly 3 years. Picture 3 years with no paycheck coming in, while every one of those bills keeps arriving right on schedule. And here's how that usually plays out without coverage. First, the emergency fund drains. Then the retirement account gets raided early. Then the debt starts. The thing you spent a decade building quietly comes apart, not from one dramatic event, but from 3 years of ordinary bills with nothing coming in to meet them. That is the exact loss you can't write a check for, and it's the one no counter ever offered to protect. Now the gut punch. Fewer than 4 in 10 workers even have access to long-term disability coverage. The single most valuable thing you own, your income, is the thing you're least likely to have protected. That's insuring backwards, in one statistic. And it's not even expensive. A policy that replaces about 60% of your income usually costs somewhere around 1% or 2% of that income a year. People will pay $300 to insure a phone and skip the coverage that keeps a roof overhead if their body gives out. And your income isn't the only ruinous loss your gut waves off. There are 2 more you can't write a check for, and both are strangely cheap to cover. The first is liability. Someone gets badly hurt, you're found responsible, and the claim runs past what your basic policy covers. It can reach your home, your savings, even your future wages. $1 million of umbrella coverage for that runs about $20 to $30 a month. Say that out loud. For about the price of one streaming bundle, you cover the kind of lawsuit that could erase everything you've built. And most people who could have it don't, because nobody ever framed it as protecting the whole life instead of a monthly line item. The third, if anyone depends on your income, is term life. $500,000 of coverage for a healthy person in their 30s runs around $25 to $35 a month. Yet about 40% of Americans, roughly 100 million people, say they need it or need more of it. Most skip it because they assume it costs far more than it actually does. Now hold the whole thing in one picture. We pour about $50 billion a year into warranties we use one time in 5. Meanwhile, 100 million of us are underinsured on life, and nearly 60% of Americans couldn't cover a surprise $1,000 bill from savings at all. That is the mistake, drawn to scale. Big money aimed at small risks, almost nothing aimed at the ones that actually end people. Now, let me be fair, because the rule bends for real life. Sometimes buying the small coverage genuinely is the right call. If you're so stretched right now that even a $300 repair would tip you into debt, then yes, for now, insure the small thing. Because the question was never, is this loss big in general? It's, can I afford to lose this right now in my life? And that answer changes as your emergency fund grows. The stronger your cushion, the more small stuff you can drop. And one warning in the other direction. Some coverage that looks small is actually catastrophe coverage wearing a boring name. Your health insurance. Solid liability limits on your car. Do not drop those to save a few dollars. That's the disaster, not the paper cut. So this was never a video about carrying less insurance. It's about carrying it in the right place, aimed squarely at the loss that could end you, instead of the one that would just annoy you. So here's the test. Take everything you pay to protect, every policy, every add-on, every counteroffer, and run it through 3 questions tonight. Question 1. If this exact loss happened tomorrow, could I write the check myself and still be okay? If yes, cancel it or raise the deductible. That's your warranty, your phone plan, your low deductible, your counter add-ons. You are already the insurance for those. Question 2. Is there a loss hiding here that would genuinely wipe me out, my income for years, a lawsuit bigger than my policy, my family losing the paycheck? Those are the ones you insure, precisely because you could never write that check. Income cover, umbrella, term life. Start there. Question 3. Am I already paying for this twice? Before you buy anything at a counter, check what your credit cards and existing policies already cover. Half the time, the protection they're selling you is something you quietly already own. Then, just move the money. Take what you are bleeding on column 1 and point it at column 2. Same monthly spend, aimed at the loss that could actually take everything, instead of the one that would only sting. Being insured was never about how many little shields you could collect. It's one question. Is the single loss you could not survive actually covered? If it is, you can let a lot of the small stuff go. Insure the disaster. Pay cash for the annoyance. That's not being reckless with your safety. That's finally pointing it at the thing that could actually hurt you. But once your coverage is aimed right, one risk is still left standing, and it isn't a disaster at all. It's an ordinary Tuesday when the market drops 10, 20%, and every instinct you have screams to pull your money back to safety. Next time, I'll show you exactly what the people who price risk for a living do when the market falls, and why it's almost the opposite of what your gut is begging you to do.